Joining us now is Julia Coronado, founder and president of MacroPolicy Perspectives. And Julia, it's great to see you. Now, I think David Einhorn was basically making a call that says Kevin Warsh is kind of going to do the president's bidding, and therefore he's in the job to cut rates. But it would seem as if the data are kind of, I guess, in the middle. They're subject to interpretation in terms of whether the Fed needs to respond anytime soon or where even the neutral rate is. So how did today's jobs number fit into that?
Well, today's jobs report included a lot of revisions and confirmed a structural reality of the U.S. economy, which is that with no immigration and an aging workforce, the rate of job growth needed to keep the unemployment rate steady is really, really low. It may be barely positive. So we're seeing a big step down in job growth, but not a big rise in unemployment. And the unemployment rate is the metric the Fed uses to gauge the balance between supply and demand. So we've seen reduced labor supply. We've seen reduced labor demand. The unemployment rate's risen a little bit, but in the last few months, it's actually ticked lower. And that tells the Fed they do not need to be in a hurry to ease monetary policy further, that we just have a structurally slower jobs market.
Well, how many cuts do you foresee, Julia? I mean, you know, just trying to sort of distill what Einhorn said. I mean, more than two is what he's saying, a whole bunch. I don't know what exactly that means, but
a whole bunch certainly is not what the current data flow are saying.
No,
the unemployment rate has moved lower. It's still low. Meanwhile, the inflation rate, the Fed's preferred gauge, is going to be about 3% at an annual rate in December. And we still think that there's some pass through of tariffs ahead. So you're really going to be looking at the second half of the year before they could see the kinds of easing in inflation trends in a stable economy that might lead them to ease rates maybe once or twice. But they're certainly not going to be in a hurry. I think in order to get a whole bunch of rate cuts, you would need to see the economy going off the rails. You would need to see the unemployment rate rising a lot further, growth really weakening. That's certainly not the kinds of guidance you're getting from companies right now, or what the data flow is showing. The consumer is slower. The jobs market is slower, but there's no signs that things are really kind of spiraling out of control. And we've got the AI tailwinds on investment. So it's really a complicated picture, but not one that says monetary policy needs to be really stomping on the gas here.